Welcome back, traders. Rober is here. Today, I have a short trade technique for you. This technique can be used with many assets. It can be a stock, crypto, or Forex. Let's meet this technique. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you. Today's technique, we will trade in the main trend. We will buy when the price rises back. The shape of the graph will be like this. You will see that the price does high or high and does high or low. Every time it does high or high and it goes back, it will have a resistance, right? And when it does high or low and bounces back, it will have a resistance like this line. And in our technique, it will wait for the price to come down until it reaches the target, but we will lock in the trade when the price goes up. This point we call a false breakout. By having additional special conditions, I will zoom in. When the price goes back to our target, we will wait for it to form a flat graph like this. Mainly, it will have to be a red diamond when it breaks through the trend. And most importantly, there will only be a diamond ring that breaks through our trend. After that, the price will go up and become a large green diamond because of many diamonds. By the point that we will buy from the first diamond after the price goes up again. For example, we will follow this graph. The price is a long up and down market, right? There is a high and a low all the way. The point that it is a low point, we will get the trend up. For example, this point has a trend up. We will wait for the price to break out and then go back up. This point is called a fall breakout. And once again, it must be only in the fall that there is a fall breakout. Once we know that the price has gone up, we can buy when the first fall is over after the fall breakout. This kind of trade is called the liquidity sweep. When liquidity or stop loss has been swept away, the price will continue to rise in the same way. Next, we will look at the setup. This strategy has 3 steps. The first step is called trend direction. Mainly, we will use the 1 5-minute time frame. The tools we will use to find the market trend. There is only one helper. Our helper is the EMA 200 line. If the price is above the line, it will be a market up. If the price is below the line, it will be a market down. And most importantly, once we get the trend, we will trade according to the main trend. The second step is to find the fall breakout. We will find the fall breakout at the same time frame, which is 15 minutes. The fall breakout will occur in the trend opposite to the main trend. If the market is a trend up, the fall breakout will occur in the trend down. If the market is a trend down, the fall breakout will become a trend up. And most importantly, when the fall breakout occurs, we will only look at the gold. If the price drops to the gold, it will be considered that this setup cannot be used. And finally, if you know it, you have to be right. If you're wrong, you can't use it either. The third step is to enter the trade. It's a sniper entry trade. Each trade has a lot of chances to make a lot of profit. We will change the time frame from 15 minutes to 1 minute. The principle? We will wait for the price to close before the candle. After that, we will enter the trade when it is a big candle, whether it is up or down. And finally, we will check the RR. The RR is mostly over 3 to 1. If the RR is 1.5 or 2, we may decide not to trade. At this point, you may have a question. In the second step, it says that the color of the candle must go through the gauge. How is it? I'll take you to see. Left hand will be up the market. The right hand will be down the market. If the price goes up, it will go up continuously. At the low point, there will be a trend that occurs all the way, right? At this point, there is a fall breakout. The shape of the candle must be like this. The idea is that the fall breakout candle must be only a red candle. The market rises, the fall breakout candle must be only red. On the other hand, if the market goes down, the price will be lower high and lower low. In the high point, there will be a resistance. And when the price breaks through the resistance and goes back down, we will get a false breakout. The moment it occurs, the false breakout will have to be a green candle with a long candle. Red will not work, but if it is green, it is considered to pass the gain. All ideas of this formula are like this. After this, I will take you to see the example, both up and down markets. In this clip, there are 4 examples of up and down markets and 2 examples of down markets. Let's start with the first example. This example starts at the 1 5-minute time frame. First, you will see that we have the EMA 200 line or the yellow line at the bottom. Therefore, we check the gain first. The market is rising. The price must be above EMA 200. At this point, look at the left-hand side. The price rose first, the price rose, and then rose again. When it rises again, the price goes up. After that, the price rose again. In this area, you will see that the price rises, but it doesn't go up far. After that, it went back to this zone many times. This area has become one that is very profitable. After that, we will wait for the price to break out. The important thing is that it will have to break out only the inside, and it has to be a red diamond. Wait for 15 minutes. The next candle is really a breakout. This point is considered to pass the gain because the breakout is only in the candle, and it is a red candle. Next, we will make a round. The main structure of the round is to build a zone. We will build a zone from the low point to the close point of this candle, which in this area is this white line. In this area, we have a zone. This zone is very important. If the price goes down lower than the zone, most of us will not trade. But if the price goes up, we will trade. It is a trade according to the main trend. Finally, in this time frame, we will find the TP point. With our TP, we will look for a swing high that is quite far away. In this place, there are 2 swing highs. The first point is around here, another point is far back. But because this point is too close, so we will choose a point that is farther away to be our TP. Once we get the TP, we will change the time frame to 1 minute. This area is the TP point from the 1 5-minute time frame. The first step is to wait for the price to close above this zone. Right now, the price is a red diamond. The price has a chance to go down first and then go back up. Therefore, we wait for a while. The price will come back and go back up. At this point, we will buy, but it will be a big green coin. From this example, we can mark the position to buy. After we buy, next we will look at stop loss and take profit. Our stop loss will be under swing low. Here, the price rises and creates a new low before it rises back up. Therefore, this point is our swing low. We can set a stop loss and mark the position. As for TP, it's very easy. We use the TP that was set from the beginning in the time frame of 15 minutes. Therefore, in this example, our RR will be around 5-to-1 or 6-to-1. And when they buy, we just wait. Wait for a while, the price will really touch the TP, get full profit in the first line. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you.